Salaries create structure. They also create payroll taxes, which some owners complain about, but they give you clean financials and a lower audit risk. The big difference? A draw gives you flexibility, a salary gives you legitimacy. Both have a place, both can be correct, but they're not interchangeable. Let's talk about one of the most confusing topics for small business owners. How to pay yourself. Is it a draw or salary? What's allowed? What's smart? What keeps you safe? And what gets you in trouble with taxes or cash flow? A lot of business owners guess their way through this. They pay themselves whatever's left over, or they take money randomly, or they avoid paying themselves because the business needs it more. And lastly, they pay themselves in a way that feels right, but creates tax problems later. And now we're heading into 2026. The IRS rules around reasonable compensation for an S corporation are getting more attention. People are hearing about audits, crackdowns, and business owners getting flagged because their pay doesn't match the industry norms. So today I'm going to explain how to pay yourself right in 2026. Whether you're an LLC, an S corporation, or a single member business. We're going to cover what owner draws are, what salaries are, the pros and cons of each, how tax works, and the method I use with clients to set up cleanly and confidently. Let's get into it. Part 1, owner draw versus salary. Let's go through the simple definitions. Let's start this with plain English. Owner draw. An owner draw is where you take money out of the business as an owner. You're not being paid as an employee. You're taking distributions. This is common for LLCs, sole proprietorships, and partnerships. Draws are flexible. You take what you need when you need it, as long as the business has enough cash. There's no payroll tax on the draw itself, but the business income still passes through to you on your personal taxes. Salary. A salary is when the business pays you as an employee through payroll. You get a paycheck. Taxes come out automatically. You get a W-2 at the end of the year. This is required for S corporations because the IRS wants business owners to be on payroll if they do meaningful work in the business. Salaries create structure. They also create payroll taxes, which some owners complain about, but they give you clean financials and a lower audit risk. The big difference? A draw gives you flexibility, a salary gives you legitimacy. Both have a place, both can be correct, but they're not interchangeable. Part 2, how this works for different business types. Every business type has a different set of rules. Here's a simple breakdown for 2026. If you're an LLC and you're taxed as a sole proprietorship, you cannot pay yourself a salary. You take owner draws. All the profits pass through to you personally. You pay self-employment tax on profit, not draws. Simple. If you're an LLC being taxed as an S corporation, this is where the confusion happens. You must take a salary. It's not optional. The salary must be reasonable compensation based on your industry norms. After that, you can take distributions or draws, which are not subject to payroll tax. If you're just an S corporation, not an LLC, the same rules apply as above. A salary is required, distributions are allowed. The mix between the two is what determines your tax outcome. If you're a partnership, partners cannot take payroll unless they're also employees delivering services in a special arrangement. Most pay comes from guaranteed payments or distributions. C corporations. Owners take salaries and dividends, but this is separate from what we're discussing here because C corporations, they pay corporate tax. Part 3. The reasonable compensation rule in 2026. Let's discuss that. Let's talk about the rule that everybody's worried about. Reasonable compensation. The IRS wants to make sure that S corporation owners aren't paying themselves like little tiny salaries to avoid payroll taxes while taking huge distributions. And as audits increase in 2026, this rule is going to matter more than ever. So what's a reasonable compensation? It's what you would pay somebody else if they did the same job that you do. Not based on revenue, not based on profit, but based on the role. If you run a business, you actually manage operations, you lead sales, do customer service, handle projects, and you run the finances. That's multiple jobs. Your salary needs to reflect that. Owners get into trouble when they decide to pay themselves like a $10,000 salary and take $150,000 in distributions. That's a red flag. A safer structure might be a $70,000 salary and maybe $90,000 worth of distributions, or $100,000 worth of salary and only $50,000 worth of distributions. It depends on the industry, the duties, your experience, hours worked, and business size. There's no perfect number, but there are ranges, and those ranges, they matter. Part 4, how do you choose the right number in 2026? Here's the method I use with clients. It's simple and it works. Step 1, list your actual roles. Yes, you're the business owner, and yes, you're in charge of operations, but you do sales and service delivery, some administration. There's leadership there. Break down what you actually do. Step 2, assign each role a market value or salary, not inflated numbers, actual market rates in your industry. You can look those up on Glassdoor, salary.com, ZipRecruiter, industry associations. You want a real benchmark of data. Step 3, adjust for hours. If you aren't doing the job full-time, adjust the number. For example, if a full-time operations manager earns $60,000 a year, but you only spend 10 hours doing that a week, then your compensation for that role is probably closer to $15,000. Step 4, add up the numbers. This gives you a reasonable compensation range. Step 5, set your salary within that range. Not the lowest number, not the highest number, somewhere in the reasonable middle. This satisfies the IRS and keeps payroll tax realistic. Step 6, take the rest in distributions. Once your salary is set, distributions are flexible. You can take them monthly, you can take them quarterly, or when cash flow permits. This is the cleanest way to pay yourself in 2026 while avoiding those red flags. Part 5, what are the pros and cons of draws versus salary? Let's break this down simply. What are the benefits of an owner draw? Well, it's flexible, it's simple for LLCs, there's no payroll process required, it's lower administration, and good for cash flow if it's inconsistent in a business. The cons of an owner's draw, though, is there's no tax withheld. It's hard to plan for. It's easy to take too much. It's easy to take too little. Personal and business finances, they get tangled. And there's no reasonable compensation protection. The benefits of a salary, it's predictable. You have cleaner books. W-2 income helps with loans. Tax withholding is done automatically for you, and it's required for S corporations. There is a low audit risk here. The cons of the salary, though, is there's less flexibility. It does take payroll taxes out, of course, and most have to run a payroll regularly. The biggest mistakes owners make. Now let's go through some of the traps. Mistake number 1, paying yourself last. It's not noble, it's destructive. If your business can't afford to pay you, the business model is broken. Mistake number 2, taking random draws when the bank account looks good. This creates chaos. Draws need structure, just like salary. Mistake number 3, paying yourself too little to avoid taxes. This is how owners get audited. Low salary and a high distribution, again, that's a red flag. Mistake number 4, paying yourself too much when cash flow is weak. A high salary in a low cash business, that drains the company. Mistake number 5, ignoring profit. Salary is compensation for work. Profit is compensation for ownership. Both matter. Here is the simplest, safest, cleanest method going into 2026. If you're an LLC, but not taxed as an S corporation, run the business with an owner pay account. Transfer money weekly and bi-weekly in consistent amounts. Use that profit first distributions on a quarterly basis. If you're an S corporation or LLC, taxed as an S corporation, set a salary that matches market rate for your duties. Pay it on a payroll, just like any other employee. Take additional distributions only when cash flow supports it. Review your compensation probably yearly. That would probably give you a good look. If you have inconsistent cash flow, lower your salary slightly. Increase distributions when cash is strong again. This structure keeps everything legal, clean, predictable, and stress-free. But here's the bottom line. How you pay yourself in 2026 isn't about taxes or compliance. It's about running a healthy business that takes care of the owner. Draws give you flexibility, salaries give you structure, distributions give you upside, and the mix depends on your business type and your role. If you pay yourself correctly, you'll avoid audits. You'll protect your cash flow, you'll stabilize your personal finances, and build a business that works for you, not against you. All right, that's it for today. If you want a clear, honest guidance that helps you run a stronger business, make sure you subscribe and check out all my other videos on this channel. I'll see you in the next one.